Hello, everybody. Hope we're all doing well today. So we're going to go ahead and take a look at a comprehensive question. So this is going to be a little bit different than the one I will do for, like, say, an earlier exam. This is really for the final exam of my class. And what we're doing is we're taking a unadjusted trial balance, looking at adjusting journal entries, and then preparing a multi-step income statement, a statement of retained earnings, and then a classified balance sheet. Now, normally, I would also have you prepare trial balances. I would have you prepare closeout temporary accounts to retain earnings, but that's kind of all ancillary in terms of like what we're going to be going through and doing here. So let's take a look at our question right over here. And we've got OAK or Oakland, or we can't refer to the A's or the athletics as that anymore. But we can do it here because there's still an airport that's named Oakland. Okay. So coming right over here, so we have this trial balance. And then let's take a look at the different items over here. Now, if you're taking my class, I intentionally made this like pretty crazy just to try to incorporate most of everything. But let's just go through here and go ahead and do it. So we have these balances here, and then we've got additional information. First thing I will be going through and asking you to do is to prepare adjusting journal entries. So take these one at a time, and let's go to the first one. Oak estimates that 20% of its accounts receivable will not be collected. So if I'm going through and doing this over here, so when I'm doing adjusting journal entries, right, I'm going to have my date, account, debit, and then credit. And what I'm also going to do over here too is I'm going to go ahead and add a few columns. And we'll call this unadjusted. So right over here, make this a little bit smaller. Again, not required for you to do. However, this is going to be a way we can kind of help ourselves out on the test or preparing. So my date for the first one over here is going to be 12/31/32. And so over here, my account is going to be bad debt expense. And I'm going to credit the allowance for doubtful accounts. Now, if I'm estimating that 20% of my accounts receivable will not be collected, this means that I have to create an allowance account, right? Because over here, if my accounts receivable on my balance sheet, right, over here is showing at 500, if I estimate that I can't collect 20% of that, I'm going to need an allowance for doubtful accounts times basically of 100, so that when I show my balance sheet, it's going to show accounts receivable net of 400. So I'm going to credit the allowance for doubtful accounts over here for 100, and I'm going to debit bad debt expense. Remember, when we go through and do this, right, you've got over here, you've got your ADA. It's going to have a credit balance because it is a contra asset account. It's reducing the carrying value of the asset. My debit over here, I need 100. This is to the ADA. So my debit is going to be to bad debt expense. That's how I go through and adjust this to record bad debt expense. So how do I go through and do this? I'm going to show over here ADA on my adjusted credit. This is going to be for 100. And then down over here below selling expenses, I'll have bad debt expense for 100. So I've gone through and I've posted those over here, and this is for letter A. Let's go ahead and go to letter B. So we go over here to letter B. That did not work out quite the way I wanted it to, but that's okay. All right, letter B. So the prepaid consulting services represents an advance that we made to a vendor on 6/1/32. They will provide the services to us at a rate of 20 per month beginning on 6/1/32. So if I look at this over here for prepaid consulting services, this was an advance I gave to a vendor on June 1st. So when I look at this on for prepaid consulting services, this had a balance of 240 on this had a balance of 240 on 6/1/32. On 12/31/32, I have gone through and I have used up some of this advance. They provided this at a rate to me of 20 per month beginning on 6/1/32. So that's going to be June, July, August, September, October, November, December. So a total of 7 months. So over here, I'm going to record my adjusting entry is going to be for consulting service expense for 140 or 20 times 7 months equals 140. For every debit, I need a credit. I'm going to credit prepaid consulting services. When I look at this, I have an ending balance after I make the adjustment of 100. Think about this logically. What does this represent? Well, this was a 12-month advance because if it's 240 and I'm being charged 20 per month, that's for 12 months. I've used 7 months of it or 140, so I should have 5 months left, or 5 times 20 is 100. So over here on 12/1/32, I'm going to debit consulting services expense over here for 140. I'm going to go ahead and credit prepaid consulting services for 140. And this is going to be to record consulting services expense. So I'm going to go ahead and put this into my adjusted trial balance. So over here, consulting services expense for 140. Now, my prepaid consulting services had a balance of 240, but now that balance is as of 100. So I just make that adjustment there and I'm good to go. Let's go ahead and take a look at letter C. The loan receivable is made on 10/1/32 and bears interest at a rate of 10%. The loan and all interest will be repaid to Oak on 9/30/37. So let's go through over here. So 12/31/32. When I loan money to somebody, I'm going to have a debit to interest receivable, and I'm going to credit interest revenue. Okay, this is always the way we go through and record this. This goes back to the very second exam, but let's go through and figure this out. So the loan receivable was over here at 600, right? So my loan receivable was at 600. Actually, no, it was inventory, but it's the same one. Okay. My loan receivable right over here is at 600. So let's put this in the right one. Loan receivable at 600. Whenever I see an interest rate, it is always going to be an annual rate. So my interest rate is going to be at 10%. My annual interest is going to be at 60, right? However, I only borrowed the money or I loaned out the money only for 3 months, October, November, December. So what I'm going to need to do is I need to multiply this by 3/12 or October through December. And I'm going to get 15. So this is going to be amount of my interest receivable and then my interest revenue. Okay, very important to go through and remember. And let me put this in the right place. Okay, so interest receivable, we're going to go ahead and put that right below the loan receivable. And that's going to be at 15. And I'm going to have my interest revenue. And this over here is going to be a credit at 15. Okay, so that's letter C. Letter D. I purchased equipment on 2/1/32. The equipment had a salvage value of 120 and an estimated useful life of 10 years. When I'm adjusting equipment, the journal entry is always going to be the same. It's going to be a debit to depreciation expense. I'm crediting accumulated depreciation on equipment. I have a lot of videos on these different topics to record depreciation expense. Okay, so when I go through and do this, I'm always going to have you do this using a straight line. So this would be my acquisition cost minus my salvage value divided by my estimated useful life. So let's see the information we know here. My acquisition cost was 720. My salvage value was 120. And it has an estimated useful life of 10 years. So this is going to be 600 divided by 10 or 60. However, this is for a full year of depreciation expense. So this is annual depreciation expense. I got the equipment on 2/1/32. So I need to multiply this amount of my annual times 11/12 or 2/1/32 to 12/31/32. Or this is going to be a total of 55. Okay, so this is my depreciation expense. And this is going to be over here, 55 and 55. So let's go through and put this into our trial balance. So over here, I'm going to have depreciation expense for 55. And then I'm going to have a credit over here to accumulated depreciation on equipment over here for 55. Remember, on the exams, if you keep yourself well organized, it's going to make a lot easier down the road. Let's go ahead and go to the next one. Okay, the unearned revenue relates to an advance received from a customer on 8/1/32. Will perform the services at a rate of 100 per month beginning on 8/1/32. So over here, the unearned revenue was 900. So over here, so we have so my unearned revenue had a balance of 1,000. This would be of 900. And right over here, I'm performing that at a rate of 100 per month beginning on 8/1/32. So my revenue is going to be for August, September, October, November, December, 5 months at 100 per month. So for every debit, I need a credit. So for every credit, I need a debit. I go ahead and debit unearned revenue. What is my balance of my unearned revenue now? It is going to be the initial 900 minus the 500 or 400. What does this represent? Well, they paid me for 9 months. They've used up 5, so I have 4 left, our 400. So my unearned revenue is going to have a credit balance of 400. And then over here, in addition to this 1,000 of revenue, there's going to be another 500. Okay, so I kind of made a mistake on this just with you right now. So if I'm going through and looking at this, there was a balance in revenue previously, right? So this would be, so my revenue is going to now be 1,500. So again, there was a balance in this previously. So this is going to be 1,000 plus the 500 I'm recognizing right over here. So the journal entry that I would be using is 12/31/32. I would be debiting unearned revenue. I'm going to be crediting revenue. And this is going to be for 500. And then also over here for 500 to record revenue. Okay. And let's make this a little bit bigger for those that are blind and who can now see. Okay. So for letter F, I'm borrowing money, but loan payable was borrowed on 9/1/32. When I have a loan payable, the adjusting entry is always going to be debiting interest expense to show the use of the money, crediting loan payable. Okay. So my loan payable amount is at 200. My interest rate is going to be at 12%. So the annual interest on the loan is going to be at 24. However, I did not borrow the money for this entire time, right? So what I'm going to need to go through and do is to make the adjustment. So I'm going to multiply this over here, borrowed it on September 1st, September, October, November, December. So over here, this is going to be times 4/12. Or this is going to be 8. Okay, so over here, I'm going to have an interest expense at 8 as a debit. And I'm going to have over here interest payable. So over here, I'm going to have interest payable. And this is going to be over here at around 8. Okay. Now, what I need to do now is to bring forward the other balances that I did not adjust, or 1,000 of cash, 500 of AR, 600 of inventory. I adjusted the 240 because I used about 140 of the services. Loan receivable of 600, equipment, don't touch it. Payables, 1,300. Loan payable over here of 200. Dish common stock did not change. Treasury stock over here at 600. My beginning rate trading earnings were at 320. I had dividends. My cost of goods sold 280, 160. And hopefully, when I've gone through and looked at all this, my total debits equal my total credits. Now, the thing I'm being asked to do over here, so I've got the adjusting entries. Remember, you don't have to do this, but I would probably highly recommend doing it just because when it comes to, uh, going through and kind of keeping track of your work, it may find it to be pretty helpful. Okay, so we got over here. We're preparing a multi-step income statement. What exactly is that? Well, when we look at public filings, We're going to go over here to the Home Depot. A single step income statement is going to simply be revenues minus expenses. I'm coming over here when we do multi-step. Sales minus cost of goods sold is gross profit less operating expenses. So what we're going to do over here is we're going to come down to this part of our financials, and we're going to make this a little bit easier for us to go through and read. So we're going to have Oak Inc. income statement for the year ended 12/31/32. So we're going to start over here with revenues. Our revenues over here are going to be 1,500. Now notice, I'm not going to touch interest revenue because that's going to be other revenue and expense. Less cost of goods sold. You're free to abbreviate on my exam over here at 280, right? And this is basically going to give me my gross profit. My gross profit right over here will be 1,220,000. Okay. So less selling, general, and administrative expenses. Okay, so here I'm pretty much going to list out everything: selling expenses, bad debt expense, consulting service expense, depreciation expense, but I'm not going to list out interest expense because that is going to be what we call other income slash expense. So my total SG&A is going to be 455. My operating income is going to be my gross profit minus my SG&A, or at 765. These categories are extremely important. Less other income slash expense. So over here, and again, how you do this, it's entirely up to you. I have my interest revenue of 15. I have over here my interest expense of 8. So my net other income is going to be over here at 7. Now, this is going to be a positive number because my interest revenue exceeded my interest expense. So my net income is going to be 772. Now, I want you to do something for me just to make sure you've done this correctly. The total credits over here are 1515. My total debits over here are going to be 743. When I subtract these two, it should equal my net income, right? Good way to go through and check. Okay, so this is for Oak Inc. Okay, so now I'm going to get down over here. Oak Inc. Statement of retained earnings. This is going to be simply my beginning retained earnings plus my net income minus my dividends is going to give me my ending retained earnings. So coming over here, my beginning retained earnings are simply going to be 320. My net income was 772. My dividends are less 20. So my ending retained earnings are now 1,072,000. Now, what I would normally do is I would close out all of my temporary accounts, dividends, revenues, expenses to retained earnings. But for this particular exam, I am not going to make you do that. So what we're going to go ahead and do is do our post-closing trial balance. So all of our expenses would have been closed out to 0, right? Our revenues, interest revenue, regular revenues all get closed out, but my ending balance now in retained earnings is 1,072,000. Now, none of the other balances have gone through and have changed, right? Remember, when we have over here our assets and our other liabilities, Okay. So this is my total debits, my total credits. So over here, I'm going to take these balances. I'm going to move these over. And now we're going to work on our balance sheet. Okay, so that's what we're going to go through and do next. And then we should be done with this. Now, on the balance sheet, if you say, oh my God, I can't remember what a classified balance sheet looks like, go to the cash flow questions. Look at how this is set up. Assets, current assets, non-current assets, current liabilities, non-current liabilities. Help yourself out and look for clues. So, not Blues Clues. I never got my kids into that show, probably for the better. Okay, so I've got Oak Inc. balance sheet as of 12/31/32. You have to do a header. Absolutely critical. Need to know what you're going through and preparing. Okay, so we're going to have over here assets, current assets. So we're going to have over here, we're going to have cash. Cash is a current asset. Accounts receivable. Now, this is really important. Accounts receivable less the allowance for doubtful accounts. This is a contra asset account. This is going to give me accounts receivable net. When I'm grading the exam, these are the kind of the little things I'm looking for. We've got inventory. We've got prepaid consulting services over here. And this is going to give us our total current assets. And this will be 1,000 plus 400 plus 600 plus 100. My non-current assets will basically be my my loan receivable. Now we get to the loan receivable. What does it have to be? For the loan receivable to be non-current, it has to be a year beyond the balance sheet date. So if this was due by 12/31/33, it'd be current. But in this case over here, it is not, right? This is due 12/9/30/37. So over here, my loan receivable is going to be at 600. My interest receivable will be at 15. And again, over here for the equipment, I'm an absolute stickler on this. The equipment is going to be 720 less accumulated depreciation on the equipment. So this is going to be less 55. This is going to give me equipment net of the accumulated depreciation. So my total non-current assets, make sure you total them up. This is going to be 1280. My total assets will basically be over here at basically 3,380,000. So this is the first part of my balance sheet. So let's now go to, those are the assets. Let's now go to the liabilities. So for my liabilities, I'm going to also have current, and then I'm going to have non-current. So for my liabilities, current liabilities. So I have accounts payable. I'm going to go ahead and abbreviate unearned revenue. So these over here are going to be 1.3 million and 400,000. Now for the loan payable, if the amount is due by 12/31/33 within a year, it's going to be a current liability. Over here, it is going to be non-current because it's beyond a year. So my total current liabilities are going to be 1.7 million. My non-current liabilities are going to be my loan payable, my interest payable of 200 and then 8. My total non-current liabilities are going to be 208. My total liabilities are going to be 1.7 million plus 208 or 1,908,000. Owner's equity. Okay, so I'm now kind of going through and combining the common stock. So you've got over here This is going to be $1 million. Now, the treasury stock, very important. This has a debit balance. So we're going to say treasury stock. It's not going to be less. We just show this as a negative amount. So over here, and then we have retained earnings. My retained earnings were 1,072,000. My total owner's equity is going to be 1 million less 600,000 plus 1,072,000. My total liabilities plus owner's equity is going to be 3,380,000, which equals my total assets. So I am done with this question. So if you're taking my final exam, right, you have to make sure you know how to do these journal entries that I've laid out over here. If you don't know how to do these quickly, it's going to be a rough day at the office. Please check the announcements because I do offer a special kind of credit because this is a kind of a replacement of part of exam two. So in any event, thank you for being here tonight or wherever you might be. I look forward to seeing you on future videos. Have a great rest of your day.